Okay, so real quick, the average Gen Z worker right now is earning somewhere around $55,000 a year. They graduated, found a job, maybe got a small raise last year, 3%, maybe 4. They feel fine about it. Their manager said great performance this quarter. Their parents said you're doing great. HR sent a congratulations email, and in the time it took to receive that raise, the cost of groceries went up. The cost of rent went up, car insurance went up, health insurance went up, the average price of a used car went up, and not by 3%, not even close. So here is the question I want you to sit with before we go anywhere. If you run faster and the treadmill speeds up faster, are you actually moving? Here is what this video is actually about. We're going to explain how wage growth works and why it's getting structurally, mechanically, mathematically impossible for most salaries to outpace what inflation is doing to your purchasing power. And more importantly, we're going to explain why this is not an accident, why most people are solving the wrong problem, and what the actual problem is underneath the one everyone is arguing about online. I'm Creeper Finance. I'm 20 years old. I've already built enough money that I never technically have to work again. I'm not saying that to flex. I'm saying it because the thing I learned about money is that it operates like a system, and most people are playing the wrong game inside that system without realizing it. They're optimizing for the wrong output. They're pulling the wrong lever. And salary is one of the most dangerous levers you can pull if you think it's the main one. Let me introduce the metaphor I'm going to use through this whole video. It's a conveyor belt. Imagine a conveyor belt moving backward, not fast, maybe 4 or 5% per year, slow enough that if you're standing still, you barely notice it at first. But you are moving, you are going backward. And to simply stay in place, you need to walk forward at the same speed. To actually make progress, you need to walk faster than the belt. And what most people are doing is learning how to walk slightly faster. Getting a raise, negotiating a small increase, switching jobs for 10% more, and feeling like they're winning because relative to last year, they are walking faster. But relative to the belt, they're still losing, or barely even. That's the economy right now for anyone whose income is primarily a salary. You're on a conveyor belt. And the belt is winning. Let's do the actual math because I think people skip this part and then wonder why they feel broke even when they're technically making more money than they ever have. Take someone who started work in 2022. Entry level, $50,000 a year. Decent. In a mid-cost city, this works. Not great, but manageable. Now, let's say they got a raise every single year, 3.5%, which is actually above average for most industries in recent years. By 2026, they're earning about $57,000. That sounds like progress. That's $7,000 more per year. But here's what happened in that same window. Cumulative inflation, combining the spike years and the cooling but still elevated years, has run somewhere around 20 to 24% across that 4-year period, depending on which index you use and which categories matter to your life. Rent in most metros up between 20 and 35%. Groceries up somewhere around 25%. Car insurance up nearly 40% nationally. Health insurance premiums up again, above wage growth, same as they've been for the past 15 years. So your salary went from $50,000 to $57,000, a 14% increase over 4 years. Your cost of living went up conservatively 18 to 22%. You got a raise every year, and you still lost, not catastrophically, not visibly, but mathematically, quietly, definitively you lost. The belt moved faster than you walked. And this is before we even get to taxes, which is the part that makes this problem about 30% worse than it looks. Here's the first thing most people get wrong. They think inflation is the enemy. Inflation is a symptom. The actual problem is that your income is structured in a way that cannot efficiently respond to inflation. Let me explain what I mean. When prices go up, some people get richer. Not despite inflation, because of it. The person who owns the apartment building makes more money when rents go up. The person who owns the grocery chain makes more when food prices go up. The person who holds assets that are repriced upward by inflation, they don't lose purchasing power. They actually gain it. Because the asset goes up in dollar terms and they can borrow against it and they can sell it into a market where dollars are cheaper than they were before. The person on a salary, though, can't do any of that. Their income is negotiated once or twice a year at best. It's denominated in current dollars. It doesn't automatically float upward with prices. It has to be manually, politically, awkwardly renegotiated with a manager who has a budget target and a boss above them who wants labor costs down. So when inflation runs at 5% for 2 years and your salary goes up 3, you didn't lose because the economy is unfair in some emotional sense. You lost because salary income is structurally slow to adjust. The system is not calibrated for you. It's calibrated for whoever owns the thing generating the revenue. That's not a moral claim. That's just how the machine is designed. And once you see that, you stop being angry at the inflation and you start asking a different question, which is, why am I primarily on salary in the first place? Let's talk about what's actually driving this. Because the inflation story is complicated and I see people online blaming one thing, usually whatever their political identity tells them to blame. But the actual mechanics are more interesting and less ideological than that. You have 3 forces running simultaneously right now, and they compound each other. First, you have structural inflation in housing. This one is basically a policy and supply story. Zoning restrictions, permitting delays, construction labor shortages, NIMBYism at the local government level. The result is that housing supply cannot grow as fast as demand in the metros where the good jobs are. And housing is not a small line item. For most people in their 20s, rent or mortgage is somewhere between 30 and 50% of their take-home pay. When that number goes up by 25% over 4 years, a 3% raise doesn't even touch it. It's like bringing a cup to a house fire. Second, you have services inflation. This is the sneaky one. Services are labor intensive. When labor costs go up, which they did for a few years after the pandemic disruptions, the price of services goes up. Haircuts, restaurant meals, therapy, childcare, plumbing, anything where a human being does the work. And services are a huge part of modern spending patterns, especially for younger generations who live in cities. And by convenience, you can't outsource your haircut to China. The price just goes up. Third, you have the asset inflation problem, which I think is the most underappreciated. In a low interest rate environment, which we had for about a decade and a half before 2022, asset prices inflate dramatically. Stocks, real estate, private equity valuations. This is great if you already hold assets. It's terrible if you're trying to acquire them. And Gen Z, entering the workforce starting around 2019 or 2020, showed up to the game right when every table had already been bought by someone else. The entry cost to the wealth building game went up faster than any salary could compensate for. So you have 3 compounding forces all making the conveyor belt faster. And on the other side, you have salary growth, which is structurally slow and politically constrained, fighting all 3 of them at once. The belt is winning by design. Now here's where it gets darker, because most people's solution to this problem is to try to walk faster on the belt. They negotiate harder, they get a certification, they switch jobs for a 10 or 15% bump, they grind. And I want to be careful here because I'm not saying that's stupid. Job hopping in particular is genuinely one of the better moves inside the salary game. If you stay at one employer, your raises are capped by their budget cycle. If you switch, you're renegotiating your market rate. The data on this is pretty clear. People who switch jobs every 2 or 3 years have historically earned significantly more over a decade than people who stay loyal. But here's the ceiling. You're still on the conveyor belt. You're just walking faster, which is better than walking slow, obviously. But it doesn't change the fundamental physics of the situation. You're still denominating your wealth building in labor, and labor has limits that capital doesn't have. You can only work so many hours. You have one body, one brain, one unit of time per day. Even if you're exceptional at your job, at some point you hit a wall. There's a maximum salary for almost every role, and that maximum salary is set by whoever owns the business, which means it's set lower than the value you generate. That's the whole point of hiring someone. You pay them less than they produce. The delta is profit. This is not cynical. This is just math. And understanding it changes what game you're trying to play. Here's a short story I want to tell you. This isn't me. This is a pattern I've watched play out in probably a dozen different variations. There's a guy, let's call him Marcus, 24 years old, got a degree in finance, landed a job at a mid-sized asset management firm making $62,000 a year in 2023. Pretty good start. He was sharp. He worked late. He got noticed. By 2025, he's making $79,000. He got a promotion and a $17,000 raise in 2 years. That's genuinely impressive. That's about 12% per year compounded. But here's what Marcus also did. He upgraded his apartment when he got the first raise, moved from a $900 a month place he shared to a $1,400 a month studio. More privacy, more status. He started eating out more because he could. He bought a car because the job was in the suburbs. He started contributing to his 401k at the company match level, which sounds good, but most of that money is sitting in a target date fund he's never looked at. His savings rate in 2023 was about 18% of his income. After the promotion, with all the lifestyle adjustments, his savings rate in 2025 is 11%. He makes more money than ever. He feels more prosperous. But his actual wealth building rate went down. The conveyor belt got faster and he responded by buying a better outfit to wear while standing on it. This is lifestyle inflation. And it's the reason that most salary increases in the real world do not translate into proportional wealth growth. The raise gets consumed immediately by upgraded living standards. It's almost automatic. It's psychological. The brain treats increased income as permission to spend more. And the market, the landlord, the restaurant, the car dealership, they're all ready to absorb that extra income before you even have a chance to think about it. Marcus isn't stupid. Marcus is extremely competent. Marcus is losing because the structure of his decisions is calibrated for comfort, not for wealth accumulation. And no one told him the difference. Okay, I want to take a step back and talk about something that I think is genuinely misunderstood. And this is one of those reversals that sounds obvious once you hear it, but most people never articulate. You think the problem is that you don't make enough money. But actually, the problem is that you don't own anything. Repeat that slowly because it sounds too simple and the simplicity makes people dismiss it. It's not about the income number, it's about what generates the income. Here's the difference. If your income comes from your time and skill, it stops the moment you stop. It also can't scale beyond your personal capacity. It's capped by negotiation with someone who has incentive to pay you less. It's taxed as ordinary income, which in most brackets is the highest rate available. And it provides no collateral for borrowing, because you can't securitize a future salary. If your income comes from an asset, an equity stake, a rental property, an index fund portfolio, a business you partially own, something that generates cash flow without requiring your active participation every hour, then it compounds. It scales. It can be borrowed against. It's often taxed at lower rates, sometimes dramatically lower if it's long-term capital gains or qualified dividends. And it doesn't stop when you stop. The same dollar earned from capital and the same dollar earned from labor are not the same dollar. They look the same. They spend the same. But the tax code treats them differently. The compounding math treats them differently. The leverage math treats them differently. In almost every dimension that matters for long-term wealth accumulation, labor income and capital income are not comparable. One is a salary. One is a stake in the machine. Most Gen Z workers are trying to get a bigger paycheck from the machine. The actual move is to own a piece of the machine, even a small piece. Even fractionally. This is where it starts to feel obvious in retrospect and completely non-obvious in the moment. Because nothing in school, nothing in most families, nothing in most social environments around a working class or middle class upbringing ever frames money as ownership. It frames money as income. Earn more, save more, spend wisely. That's the full curriculum. Ownership, leverage, compounding, tax structure. Zero. This is a good time to say, if you're watching this and you're not subscribed, think about what you're doing here. I put out videos that explain the actual mechanics of money without the motivation porn and without the fake lifestyle content. If that's useful to you, subscribe. It costs you nothing. It means you don't miss what comes next. Let me build on the ownership point because I want to show you the actual math of why this matters so much in the context of inflation specifically. Say you have two people, same age, 22, same starting income, $55,000 a year. They both save 15% of their income, about $8,250 per year. Person A puts their savings into a high-yield savings account, maybe earns 4% annually. Safe, sensible, what their parents would recommend. Person B puts their savings into a low-cost broad market index fund, historical average returns somewhere around 9 to 10% annually before inflation. Let's be conservative and use 8.5. Over 30 years, assuming similar income and savings rate throughout, Person A has accumulated approximately $470,000. Not bad. Person B has accumulated approximately $1,100,000. That's a 2.3 times difference. Not from earning more, not from working harder. From the vehicle from where the money was parked. Now add inflation to this. At 4% annual inflation, which is rough but not far from the recent reality, that $470,000 in 30 years has a real purchasing power of roughly $145,000 in today's dollars. Person A worked for 30 years and saved diligently and ended up with the equivalent of about $145,000 in today's money. The conveyor belt eroded their savings while they were sitting still. Person B's $1,100,000 at 4% inflation is roughly $340,000 in today's purchasing power. Still better. But you see what inflation does even to reasonably good investment returns. It's a tax that never stops running. The high-yield savings account returned 4%. Inflation was 4%. Real return was 0. The person who was being safe actually ran on the belt perfectly in place for 30 years and ended up with nothing in real terms. I don't say this to be dark. I say it because this math is running on literally millions of people right now and no one is telling them. Let me cut away for a second. Imagine the financial planning meeting where someone finally figures this out. The advisor slides over a chart. It shows 30 years of careful, responsible savings. It shows the inflation-adjusted balance. It shows a number smaller than what they put in. The person looks up and says, "But I did everything right." And the advisor nods slowly and says, "You did. Saving is great. You should keep doing it." Would you also like to know how money actually works? Back to the system. Here's what I think is the most counterintuitive part of this whole thing. And this is the point where most people get genuinely uncomfortable because it challenges a belief that feels moral. The belief is this: hard work should lead to financial security. Effort equals reward. If you work hard enough at a job, you will be okay. I want to be precise here. I'm not attacking that as a value. I'm analyzing it as an economic hypothesis. And the hypothesis doesn't hold under current structural conditions. Here's why. The relationship between effort and income inside a salary structure is almost entirely mediated by your employer's incentive system. Your manager doesn't reward you based on your absolute output. They reward you based on your output relative to your replacement cost and relative to the budget they've been allocated. If you work twice as hard and produce twice as much value, but your manager's budget only allows for a 3% raise pool, you get 3%, maybe 4% if they like you. The effort to reward pipeline leaks, most of the extra value you generate goes to the company, not to you. This isn't a moral failing on anyone's part. It's just what happens when one party sets the pay and the other party does the work. The incentives are misaligned. The employer wants to pay as little as possible to keep the person. The employee wants to earn as much as possible. That tension always resolves in the employer's favor over time, because they have more information about what the market pays, more leverage in the negotiation, and a systematic interest in keeping labor costs down. Now add inflation. The employer's interest in keeping labor costs down now directly conflicts with the employee's need to keep up with rising prices. And historically, across most industries, the employer wins. Real wage growth, that is, wages adjusted for inflation, has been flat to negative for median workers in the United States over the past 4 years. Flat to negative. That means the average worker worked every week, got paid every 2 weeks, and at the end of the year had less purchasing power than they started with. Despite working, despite getting paid, the treadmill moved faster. The system is not designed to make labor wealthy. It never was. Understanding this is not cynicism. It's navigation. Let me talk about the psychological dimension because I think it's one of the most underappreciated parts of this whole thing. There's a concept called hedonic adaptation. When your income goes up, you feel better. For a while, then you adjust. The new income becomes the baseline. The new apartment becomes normal. The restaurant meals become expected. Your brain recalibrates to the new normal and returns to roughly the same baseline satisfaction level. Then you need more. Not because you're greedy in any meaningful character sense, because that's literally how human psychology works. We are adaptation machines. The economy knows this, or rather the economy has evolved to exploit this. Marketing exists to accelerate the cycle. The moment you have slightly more income, there is an entire infrastructure waiting to convert it into lifestyle and status signals that feel necessary, but are actually optional. And because the social environment around you is also adapting upward as people earn more in their careers, the baseline shifts. Suddenly, a 10-year-old car is embarrassing. Suddenly, splitting an apartment at 26 feels like failure. Suddenly, the vacation you couldn't afford 2 years ago feels like a basic right. None of this is your fault in any moral sense. But it is your problem in a practical sense, because every dollar that goes into lifestyle adaptation is a dollar that doesn't go into ownership. And once you understand the conveyor belt, you understand that the lifestyle upgrade is the belt speeding up inside your own bank account. You're voluntarily handing it money. The gap between income and wealth is almost entirely made of hedonic adaptation and lifestyle inflation. Not bad luck, not inadequate income. Adaptation. Every time. Across almost every income level. Here's the second comedic cutaway I promised. Picture a 23-year-old in their first corporate job. They just got their first real paycheck. They look at the gross number and feel powerful. Then they look at the net number after taxes, health insurance, and the mandatory 401k deduction they agreed to without reading anything. They say, wait, where did my money go? HR sends a pamphlet titled something like Your Benefits Package, a Value Worth Thousands. It contains 17 acronyms and a chart that makes no sense. At the bottom it says, you're already saving for the future. Great job. They read the pamphlet 3 times, they still don't know where their money went, they call their parents say that's just how it works. That's how we end up here. Let me now talk about a specific thing that I think Gen Z specifically is getting wrong. Not because they're dumb, but because the information environment around them is optimized for engagement, not accuracy. The narrative that's everywhere right now is that the problem is the economy, the system is rigged, boomers had it easy, housing is impossible, avocado toast jokes in reverse. And look, some of that is directionally true. Housing affordability is genuinely worse. Student debt is a real structural burden. The entry cost to asset ownership is higher in real terms than it was in 1994 or 2003. But here's where the narrative becomes a trap. When the frame is, the system is broken and it's not my fault, the psychological move that follows is passivity. I can't win, so why try? Or I can only win through collective action and redistribution. Neither of which helps you personally in the next 10 years. The better frame is this. The system is working exactly as designed. It rewards ownership, it punishes pure labor, it always has, and within that system there are paths that are harder than they were before, but still very much available. Index fund investing, equity compensation negotiation, business ownership, real estate with smaller down payment vehicles, digital income streams with low startup costs. The paths are different from what your parents used. They're not closed, but you cannot find the paths if you're standing on the conveyor belt looking backward and analyzing why the belt is moving. You find the paths by asking a different question. How do I stop trading only my time for money? That's the question. Not how do I get a bigger salary? That's still the belt. Let me get more specific about what actually works, because I never want to just diagnose a problem without telling you what the actual solution space looks like. I think about this in 3 levels. Not 3 steps, 3 levels of the same game. Level 1 is damage control. This is where most people are and where everyone should start. The goal here is to stop losing to inflation passively. Stop parking money in savings accounts that return less than inflation. Get into broad market index funds immediately. Even a small position. Even $50 a month. The point is to get capital into a vehicle that beats inflation rather than ties it or loses to it. At this level, you're not getting rich, you're just stopping the active bleeding. Level 2 is leverage optimization. This is where you start to think about what you own relative to what you control. Employer equity, meaning stock options or restricted stock units if your company offers them. This is critical. Negotiating equity into your compensation package, especially at early stage or growth stage companies, can be worth multiples of your salary over a 5-year window. Most people don't ask for it, most people don't know how to evaluate it, but this is one of the most asymmetric opportunities available to knowledge workers, and it's almost entirely ignored in standard career advice. Owning a fraction of the thing you help build is categorically different from being paid to help build it. Also at level 2, you're thinking about side income streams. Not side hustles in the hustle culture sense. I mean income that is not purely correlated with your personal hours. A newsletter, an online course, a small product, a YouTube channel, freelance work that can scale, anything where the ceiling is not your personal time limit. The goal is to have at least one income stream that isn't directly proportional to your hours worked, because the moment you have that, you've slightly gotten off the belt. Level 3 is capital allocation. This is where you're thinking about what assets you own and how those assets generate returns that compound without requiring your labor. Real estate, equity portfolios, business ownership, royalties. At this level, inflation stops being your enemy and starts being your tailwind, because you own things that reprice upward when prices go up. This is where the conveyor belt switches direction for you. Most people never reach level 3. Not because they can't, but because they never even frame the goal correctly. They're optimizing for income when they should be optimizing for ownership. The system is designed so that labor income keeps you comfortable enough to stay on the belt. It's just below the threshold where you'd stop and say, wait, something is wrong here. Let me come back to the conveyor belt one more time because I want to be precise about what I mean. The belt is not the economy in some abstract sense. The belt is the combination of inflation, lifestyle adaptation, and labor-only income working together to ensure that your net worth stays roughly proportional to your income, which stays roughly proportional to your employer's incentive to pay you just enough. Getting off the belt doesn't mean quitting your job. It doesn't mean becoming an entrepreneur in some romantic sense. It means redirecting a meaningful portion of your income consistently into assets that generate returns independent of your personal labor. Not touching that money, not adapting your lifestyle to absorb it. Letting it compound. This sounds simple, and it is simple. The hard part is psychological, because the belt is comfortable. The belt gives you regular paychecks and manager approval, and a sense of progress. The belt has health insurance and a retirement plan that looks okay on paper. The belt is what everyone around you is on. Getting off, even partially, feels risky and weird and lonely. And the financial services industry, paradoxically, often has incentives to keep you on it, because complex managed products generate fees that index funds don't. The system wants you on the belt, not maliciously, systemically, because a comfortable consuming labor force is a predictable, stable one. And stability is what institutions are optimized for. Here's the deeper thing that I think most financial content misses. And this is the point I actually want you to leave this video with. The problem isn't that you're not working hard enough. The problem isn't even that inflation is high, although it doesn't help. The problem is that you're trying to solve an ownership problem with an income solution. You think the problem is that you're not earning enough. But actually the problem is that you're not owning anything, and earning more money while it helps doesn't solve the ownership problem if that money gets consumed by lifestyle adaptation or sits in an account that beats nothing. This is why you can see people earning $150,000 a year who have less real wealth than someone who earned $60,000 and invested it intelligently for a decade. Income is not wealth. Income is the input. What matters is what happens to it. And what's supposed to happen to it is that it buys you small stakes in things that generate returns without requiring you to show up. The wealthiest people I've observed, not on social media in the actual world, are not the people with the highest salaries. They're the people who converted income into ownership early and let compounding do its thing. They're boring. They live in normal houses. They drive normal cars. They don't post about it. The system rewarded them precisely because they refused to let the system consume everything they earned. Let me circle back to where we started. The question was simple. If you run faster and the treadmill speeds up faster, are you actually moving? The answer is no, not in any net wealth building sense. Not if your entire strategy is to run faster. The actual move is to step off the treadmill. Even partially, even with one foot, here are 3 things, not motivational, not generic, that actually matter. First, calculate your real savings rate right now. Not what you save before expenses, what percentage of your gross income, after taxes, after everything, actually moves into an asset that beats inflation. If that number is below 15% and going into vehicles that don't beat the inflation rate, your wealth is declining in real terms regardless of what your salary does. Fix this before you do anything else. Second, understand your equity position at work. If you work for any kind of company that offers stock, options, or profit sharing, this is the most underutilized lever available to labor workers. Negotiate for it. Understand the vesting schedule. Understand what happens at a liquidity event. This is how people who seem like they make ordinary salaries end up with surprising amounts of money in their 30s. They were partially paid in ownership and they didn't give it back. Third, separate your income goal from your ownership goal. These are not the same number. Your income goal is about paying for your life. Your ownership goal is about building something that eventually pays for your life without you. The second goal requires a different decision framework than the first. You need to know what it costs to reach a point where your asset income covers your basic expenses. That's the number. Not the salary number, the asset number. When you know it, you can work backward to what ownership position you need to accumulate and by when. The conveyor belt doesn't stop, but you can get off it. And the earlier you start, the less belt you have to fight. If this is the kind of thinking you want more of, subscribe. One click, you stay in the loop.